Dear students, in this video I am going to make a presentation on the new chapter, that is final accounts of a sole trader, video number 1. I am Dr. Panduranga Nayak, Principal, Swiss College, Bantwal. Okay, what are the two important objectives of adopting final accounts or accounting? So there are two main objectives. Number one, to ascertain profit or loss made by business during the given period. A businessman at the end of the year or end of the accounting period would like to know whether he earned profit or incurred loss of his business. Then secondly, to know the financial position as on the last day of the accounting period. These are the two objectives of adopting accounting by any businessman for that matter. Number one, to find out whether the business has earned income or incurred loss, profit or loss during the given period, normally 12 months. Then at the end of the accounting year, what is his financial position, whether the assets are more than liabilities or liabilities are more than assets. So these are the two main objectives of the business. To ascertain the profit or loss of the businessman prepares an account called trading account and profit and loss account. Actually, these are two parts of the same account, trading and profit and loss account. So trading and profit and loss account is prepared to find out the profit or loss of the business. And to ascertain the financial position of the business, he prepares position statement. It's also called a balance sheet. The trading and profit and loss account and balance sheet prepared by a businessman at the end of the trading period are collectively called final accounts or financial statements. Why they are called final accounts or financial statements? They are prepared at the end of the accounting period to know the profitability position as well as to know the financial position. Therefore, they are called final accounts or they are called financial statements. We'll take up the first one, trading account. So, first object is to know the profit or loss of the business for a given accounting period. So we have to prepare a trading and profit and loss account. It has got two components. Normally, trading and profit and loss account is prepared together, but it has got two parts. First one is trading account. What is trading account? Trading account is an account which shows merely the result of trading. Trading means what? Buying and selling of goods. And trading result is either gross profit or gross loss. So a trading account is an account which shows merely the trading result of trading, that is buying and selling of goods, called gross profit or gross loss. The difference between the two sides of trading account is either gross profit or gross loss. If the credit side is more than the debit side, there would be gross profit. On the other hand, if the debit side is more than the credit side, there would be gross loss. In other words, it is difference between the net sales and cost of goods sold. On the credit side, you have got net sales. Then you have to find out the cost of goods sold. The difference between the two is either gross profit or gross loss. When the net sales exceed the cost of goods sold, the difference is called gross profit. When the cost of goods sold exceeds the net sales, the difference is called gross sales. And the question is, what is cost of goods sold? How to calculate that? It is calculated in the following manner or following this formula. That is, opening stock of goods, add net purchases of goods. Net purchases means purchases minus purchases returns. And all direct expenses. All direct expenses include carriage, cartage, freight, import duty, clearing charges, dock dues, GST or octroi, that is local taxes, wages, power and other manufacturing expenses. put together, that is called direct expenses or recurring expenses on purchases. Only on purchase, not on sales. Minus closing stock. I repeat, cost of goods sold means opening stock. Add net purchases, that is purchases minus purchase returns, plus all direct expenses or non-recurring expenses on purchases like carriage, cartage, freight, import duty, clearing charges, dock dues, GST, octroi, wages, power and other manufacturing expenses minus closing stock. Okay, more about that you'll learn when we start solving the problems. Now let us look at the form of trading account. So heading is, our title is trading account for the year ended, for example, 31st March 2020. Okay, so two sides are there, debit side and credit side. The debit side you have to write opening stock. Then two purchases less purchase returns, you'll get net purchases. Then all direct expenses, which include wages, carriage inwards, cartage, import duty, power and fuel, import duty. I have repeated this, import duty, sorry. Power and fuel, clearing charges, dock dues, octroi. Octroi means local taxes levied by municipality or other local body. GST on purchases, other manufacturing expenses. Put together, they are called direct expenses or non-recurring expenses. Then on the credit side you have got by sales minus sales returns, which means net sales. Then closing stock. Then you have to compare the two sides, total of two sides. If the credit side is heavier than the debit side, the balancing figure would be gross profit or gross profit, and that is to be transferred to profit and loss account. So to profit and loss account, and you find out the balance, that is nothing but gross profit. On the other hand, if left hand side is debit side is more than, total of debit side is more than credit side, the difference has to be transferred to profit and loss account, and that is nothing but gross or loss. So gross profit if the credit side is more than debit side, and gross loss if the total of debit side is more than credit side. You don't find both gross profit and gross loss simultaneously, either gross profit or gross loss. Come to the profit and loss account. Profit and loss account is an account which shows the net profit or net loss of a business for a particular period. While trading account shows gross profit or gross loss, profit and loss account shows net profit or net loss, either net profit or net loss. In the profit and loss account, what do you show? First, gross profit is entered on the credit side of the credit side, and if there is a loss, it will be entered on the debit side. So here I see two profit and loss account. That means profit and loss account is credited by this balance, that is trading account, which is nothing but the gross profit transfer. If there is a loss, then profit and loss account is debited and trading account is credited. Trading account is credited by profit and loss account. Yes. Then all the non-trading incomes other than those entered in the trading account, such as interest received, commission received, rent received, discount received, income from investments, bad debts recovered, interest on drawings, have to be entered on the credit side of profit and loss account. All non-trading incomes are to be entered on the credit side of profit and loss account. Similarly, on the debit side, all indirect expenses, all the expenses other than direct expenses entered on the trading account have to be entered on the debit side of profit and loss account. That includes, for example, salary paid, rent paid, commission paid, bad debts, depreciation, repair. So such other items, selling expenses, maintenance expenses, distribution expenses, all these are to be entered on the debit side. Finally, net profit, finally the profit and loss account has to be balanced. If the credit side exceeds the debit side, the balance is called net profit. On the other hand, if the debit side exceeds the on the other hand, if the debit side exceeds the credit side, the balance is called net loss. These are very simple things which you already come across. This is a repetition of what you have learned already and recall of what you have learned already. Now let us see the form of profit and loss account. As mentioned, first on the credit side by trading account, because the balance in the trading account is transferred to profit and loss account. That is nothing but gross profit transferred from trading account. On the other hand, if there is a loss, instead of crediting, it will be debited to trading account. There is a gross loss. Then on the credit side, all non-trading incomes are recorded, like rent received, commission received, discount received are earned. More appropriate is discount earned rather than discount received. Bad debts recovered, interest received. All these non-trading incomes are recorded on the credit sides. Then come to the left hand side, as I have told you, first gross loss is recorded here to trading account because this balance is transferred from trading account if there is a gross loss. And all indirect expenses, these expenses are not relating to specific transaction. They are relating to all the items in general. For example, salaries of the office salary. That's meant for the entire office. You cannot identify that to specific transaction. Salaries paid, rent rates, taxes, office lighting and heating, printing and stationery, insurance, postage and telegrams, general expenses, telephone charges, audit fees, legal expenses, repairs, depreciation on fixed assets, interest paid, discount allowed, bad debts, maintenance expenses like repairs, carriage outwards, commission paid, traveling expenses, then interest on capital. These are all indirect expenses. Actually, there are different categories like office and administrative expenses, selling and distribution expenses, maintenance expenses, financial expenses, etc. Actually, these will fall under any one of these heads. Okay, ultimately, you have to find out the difference between the two sides. If the credit side is more than debit side, it is nothing but net profit. But it is transferred to capital. Actually, you can write to capital within bracket net profit. If debit side is more than credit side, the balancing figure is net loss and it is transferred to capital. Instead, you can write by capital within bracket net loss. Here, to capital within bracket net profit. So you cannot have both net profit and net loss simultaneously. The credit side is more to capital within bracket net profit. The debit side is more than credit side, the net loss, then by capital. Anyway, that's about profit and loss. Now come to the balance sheet. What is a balance sheet? Balance sheet contains the balance of all real accounts and personal accounts. Real accounts means asset accounts. And personal accounts could be assets or liabilities. In other words, it is a statement of assets and liabilities of a business as on a given date, usually on the last date of the trading period. Normally, financial year is chosen by every businessman, but there is no hard and fast rule. They can even choose even the calendar period or any other period, but it's a period of 12 months, and normally it is the financial year period that is ending on 31st March. It shows the financial position of a business on the last day of the trading period. The balance sheet has two sides. All the liabilities and capital of the proprietor are shown on the liability side, and all the assets are shown on the asset side. You don't find debit side, credit side, because that is not an account. Balance sheet is a statement and not an account, unlike trading account and profit and loss account. Okay, what is the form of balance sheet? There is no prescribed form of balance sheet for a sole trading concern. However, assets and liabilities may be shown in any one of the following order. We call that grouping of assets and liabilities or marshalling of assets and liabilities. Okay, one is it is arranged in the liquidity order. The other one is in the order of permanency order. Liquidity order means what? If you come to the asset side, all assets which can be converted into cash easily, they are written first, entered first. And those assets which cannot be converted that easily and they are almost permanent, they are written at the end. Similarly, as far as liabilities are concerned, liabilities to be paid immediately or in the very immediate near future, they come first. And most permanent or fixed liabilities come at the end. Look at the order of permanence. The fixed assets come to the asset side, current assets are written first. There also in the order, for example, cash in hand, it is already in the hard cash form. Cash in bank, bills receivable, which can be converted into cash very easily within a short period of time. Sundry debtors converted into cash, closing stock, prepaid expenses, outstanding income. These are coming under current assets. Current assets are written first. Most liquid assets. Then investments. Then fixed assets. Fixed assets include loose tools, furniture and fixtures, vehicles, plant and machinery, land and building, goodwill. So most permanent assets, they will come at the end. So current assets, investments, and then fixed assets. If you follow the order of permanence, the order will be reversed. Fixed assets will be written first, investments will be written next, and current assets also will be written at the end. Now look at the liability side as far as the order of liquidity is concerned. Current liabilities are written first, which are to be paid either immediately or in the near future, immediate near future. Say bank overdraft, bills payable. What is bank overdraft? So if you draw the money from the bank more than the balance, we can call that overdraft. So normally your account shows a debit balance if you have got balance in a bank. But if it is overdraft, it is a credit balance. So you draw more than the balance in your account. Of course, you need to have prior arrangement with the banker to draw more than your balance. Then bills payable, sundry creditors, outstanding expenses, income received in advance. All these will come to the liability side. First item. Then long-term or fixed liabilities, long-term loans and long-term deposit. The capital will come at the end. Actually, this is the order of liquidity. And the other procedure is, or other format is order of permanence. In that case, capital will be written first, then long-term or fixed liabilities will be written next. After, at the end, you will write current liabilities. There also, you follow the order of permanence first. Then as far as current assets, assets are concerned, first you write fixed assets, then you write investment, then you write current assets if you follow the order of permanence. So I have already explained this. So that's about final accounts. Final accounts consist of, final accounts has got two objectives. One is to know the profit earned or loss incurred during a given period of time. For that you prepare trading and profit and loss account. And the other one is to know the financial position as on a particular date or at the end of the accounting period. That's why you prepare position statement, or you also call that balance sheet. So trading account is prepared to find out the gross profit or gross loss, and profit and loss account is prepared to find out the net profit or net loss. And balance sheet is prepared to know the financial position. It is a statement of assets and liabilities as on a particular date. And you prepare that with the help of real accounts as well as personal accounts. Okay, thank you.